Welcome back. My name is Arya, and I don't waste your time, so let's get straight into it. Ladies and gentlemen, in today's video, there's no other way to put it. We have a jam-packed episode covering a variety of different topics, starting with the earnings review of what I like to call the new big tech. Now, I like to place roughly 6 constituents in this category, but for the scope of today's video, we're only going to be covering the earnings of Uber, which I am a massive bullish shareholder of. DoorDash, which of course is a similar-ish business. And actually, it'll be very interesting to kind of compare and contrast the differences in earnings for the two of those businesses. And then lastly, we're going to be covering Shopify, which is a company that I've become increasingly interested in to open a position. But unfortunately, the valuation's a bit stretched, which again, we're going to cover all that later on in the video. After that, we're going to be covering the new Google news. If you haven't kept up with it, or if you're watching this at some point in the future, yesterday, Apple, during their FTC lawsuit or whatever in court, one of the key executives at Apple basically said that they're actively exploring and having discussions with other companies to move away from Google and have another AI LLM company be defaulted onto the Apple installed base. Google stock promptly fell about, I think, 8 or 9% yesterday. It's up a little bit today, but nonetheless, the stock has definitely been hit over the past 2 days. And so we're going to cover that news, what's going on there, what was exactly said, and actually, I'm going to give a sort of counter argument in terms of why I think the current valuation is actually reflecting a very pessimistic look, even if we were to assume that search is going to be massively impacted as a result of this, and just in general moving towards a world where people use LLMs more than search. I also had quite the controversial, I shouldn't say controversial, but I had this Twitter post. It did quite well, as you could see, but apparently something I said in here was quite controversial, so we're going to cover that. And then additionally, staying inside of the realm of big tech, Amazon actually unveiled this new robot called Vulcan, and this is starting to sound a little bit dystopian, but apparently it is the first robot in the world with a sense of touch. They're becoming more human by the day, so we're going to be covering that news as well. And then at last, I opened a new position in a smaller market cap, lesser known business known as Hims and Hers, and I'm actually quite excited to talk about this later on in the video, but I'm going to be doing a sort of deep dive like I've done with other businesses that I've bought into in the past as well. That'll be a fully separate video, but anyways, we'll cover that later in the video as well. So with all that being said, first and foremost, we're going to be covering Uber's earnings. In order to do that, I'm going to be using finchat.io, which is the world's greatest stock research platform built for fundamental investors with coverage on every stock in the world. They seriously have global equity coverage. If it's listed publicly, it's on FinChat and there's data for it. And then additionally, what's really special about FinChat compared to other stock research platforms is they have a beautiful charting interface, which if you've been on Twitter at all, I'm sure you've come across some FinChat charts. And then additionally, there's some data to suggest that we actually learn through visuals 60,000 times better than if it were simply just text in a table. And of course, FinChat is built with a high emphasis on visuals and charts and being able to pull in over 20,000 different metrics. And then additionally, we have a full segments and KPIs tab that gives you company specific metrics, such as the revenue of specific segments, a breakdown of those revenues by geography, or company specific KPIs, such as the monthly active users, the total number of trips that Uber did. And lastly, FinChat is the only stock research platform where they've aggregated KPIs on 2,000 different companies. And so if you're interested in trying it out, you can get a 2-week free trial using the link in the description down below, and then 15% off paid plans after that. Now, with all of that out of the way, there's a couple different ways we can dive into the Uber earnings. I think we're going to go over the slides. Let's just go over the slides. And by the way, perhaps I'm very biased here in saying this, but I think it's true. Out of all the company investor slides that I've ever really looked at, I think Uber has some of the most impressive slides where they actually give you very interesting data that is very relevant to the company. Actually, you know what? I lied. I think Mercado Libre might edge out Google on that front. They have an incredible investor slideshow with a whole bunch of KPIs and everything like that. So I think I would give first place to Mercado Libre, then Uber. Anyways, with that out of the way, the first thing they put in front of you, and I guess this is a point of contention for the business. I guess this is something that people are worried about, is that they're a global leading delivery player in over 30 different countries. And then this is specifically for delivery, not mobility, which is the ride side of the business. Out of the top 10 countries that they're in, which is all of these flags, I think the only flag here I don't recognize is this one right here, but believe that's Taiwan. Anyways, out of their top 10 countries, they're the leading delivery player in 8 out of those 10 countries. And by the way, straight out the gate here, United States isn't actually their best market. They only have a 30% delivery market share in the US, and they're second to DoorDash. So actually, out of the 10 countries listed here, the US, funnily enough, is one of the 2 where they don't have the leader position. And then in Australia and Canada and France, those are the top 3 markets for Uber. They're by far massive for both mobility, and they're massive for delivery as well, right? And then over here, they highlight that the growth of the gross bookings is actually like how Brian Stoffel kind of described it. It's the amount of money that's changing hands. So when you go into an Uber and, you're paying $20, $20 is going from your pocket to other parties involved there. Not all of that is going to Uber and the driver. On average, I think maybe about 60% of that should be going to the driver. There's a good 10-20% in the middle there that goes into insurance costs. And then Uber on average keeps about 20-25% of that transaction. I understand that doesn't add up to 100%, but I think you guys get the idea of the split between how much money is sort of changing hands, right? So what you should do whenever you see a gross bookings number is you take this 82 that they did in this quarter and you essentially divide that by 4. That's how much revenue Uber should be doing during this period. Now, this is a annualized run rate, which I'm not sure why they would do that. I believe that's what they are. Yeah, annual run rate. But I'm quite sure that the gross bookings of Uber is like 150. I don't really understand this KPI here. And then the second slide that they put for us is that they're pursuing massive opportunities in local commerce throughout new products and technology. This has been a known thing. The grocery business for Uber, which I'm sure many of you are quick to laugh at. They're like, oh, who's going to ever order groceries off of Uber? It's about 3 times bigger than Instacart. And like Instacart is known as like, the company that is the grocery deliveries and that type of stuff. It's quite niche. I've only heard of one person ever saying, I'm going to Instacart some groceries to my house today. But I mean, the point still stands, right? Like it's a pretty sizable business in terms of gross bookings. I think grocery, it says it right here, grocery and retail combined is a $10 billion a year business for them. So that's, in the grand scheme of things, I think Uber does 170 billion-ish. In terms of gross bookings, the money changing hands. So 10 billion is quite a sizable percentage of that, and it's growing quite fast to my understanding. So this is quite fun here. They say that 18% of MAPC is monthly active platform customers, which basically stands for like if you are using Uber Eats and Uber, you count as one person is kind of the thing that they're saying there. And so about 1 in 6 people that are monthly active users of Uber they've at least ordered something with the grocery and retail side of the business. And in a second here, when we jump back over to FinChat, you'll see that the acceleration and growth for the delivery side of the business is partly due to the fact that they've been able to cultivate this new business in grocery and retail. And then on the earnings call, because I listened to that, they said that I think specifically grocery is finally a profitable business for them. So it was previously break even to slightly negative for them. They were slightly losing money on it. And then now it's become a slightly profitable business for them. It's still lower margin than the pure delivery business and even lower margin than the mobility business, which is the crown jewel of the company. But nonetheless, it just adds yet another thing that Uber does, and it's growing incredibly fast. It's going to continue to grow in the future. Now, I didn't know this, but this is unbelievably incredible statistic for Google. And this is in the span of 1 year this has happened. Last year, half of the gross bookings of Uber. So again, I'm going to keep repeating it just in case you missed it, but that's the money changing hands. Half of that was driven by Uber One members. And Uber One was a pretty sizable membership last year. I think they had maybe about 15 million people that had it. And so this year, it grew to 60%. So now we're approaching 2/3 of Uber's business effectively is driven by about 18% of users. I'm going to repeat that sentence one more time. 60% of their gross bookings is driven by only 18% of the users. So what you have here is just a whole bunch of things are happening at the same time. One, we're kind of seeing the Amazon Prime model or maybe I would say early Amazon Prime model, because everybody has Amazon Prime now, where you're getting a huge amount of scale benefits from having a small cohort of power users of your product. And ultimately for any subscription, any sort of service like this, that's something that you would really want to cultivate and build, because particularly with like mobility, you would imagine ultimately what you're solving for, at least on the driver side of the equation, because you're a place for people to work and make a above minimum wage income. The issue with that is that if you have drivers that are waiting, for example, 10 minutes between each ride, they're probably going to do maybe 2-3 rides per hour. And ultimately, they're going to come in about minimum wage, maybe a little bit higher than minimum wage. So ideally, you have them do a higher frequency of rides. If your average driver is doing, for example, 5, maybe 6 rides per hour, that's amazing. That's beautiful. They're going to be making north of 25 bucks an hour. I remember seeing a stat like this, if the average driver of Uber didn't have any downtime between each drop off of a driver and getting the next person to drive, or getting a order to go deliver some food, or whatever the case may be, if there was no downtime between that, they would be making north of $30 an hour, which is incredible for, essentially being a taxi driver. $30 an hour, even after factoring in, insurance costs and taxes and the car costs and everything in between, the gas. $30 an hour is a great amount of money for that type of a job. But unfortunately, we live in a world where this isn't the case. And this isn't the case because of sheer amount of scale. So what you have with the Uber One membership, and this is a fact, Dara himself, the CEO, he mentioned this, when somebody becomes an Uber One member, on average, they transact about 3.5 times higher than when they are not an Uber One member. And so, there could be some correlation and causation issue there where, like, the people who are already transacting in a high frequency with Uber, odds are they're probably going to get Uber One to save 5% per trip, or 5% per delivery, whatever the case is, right? So that's definitely playing into it. But I think the numbers are overwhelmingly pointing to the fact that the Uber One membership is already massive. It's still growing about 60% year on year. I'm not talking about it making up 60% of gross bookings. That's also true. The number of members year over year are growing 60%. And so ultimately what you have is these people, and the same thing happens with Costco, the same thing happens with Amazon. Once you start paying for a membership, you are almost psychologically swayed to spend more on the platform to kind of get your money's worth, right? Let me, particularly with Costco, this is like a massive case because they have that 2% cash back. Uber has a 5% cash back. So even if, we like to admit that, like, oh no, it could possibly impact me, I couldn't fall for such a thing. Subconsciously, this is exactly what's happening. It shows up in the numbers, and this is a huge bull thesis for me personally because, it gets the flywheel spinning even faster. It helps out the drivers because there's higher frequency number of trips for them. It helps out the users, and it makes them stickier compared to like DoorDash or whatever. Like if you get the Uber One membership for mobility on Uber, odds are you're not going to use DoorDash because it translates over to the Eats side of the business. And so they're multi-platform, and it just makes the entire business work better. That's kind of what I'm getting at. And then you have the added benefit of they have in the future a subscription stream of revenue. And you've seen how incredibly high margin that is for Costco, how incredibly high margin that is for Amazon. So overall, the Uber One membership is just a force to be reckoning with. It's been incredible. If I could quickly add from this chart as well, they say that in terms of the earners, the cost of getting a new driver is about half when they're coming over from one of the other apps. So, in theory, if it costs them $50 of marketing, I actually don't know how they calculate this, but if it were to cost them $50 of marketing to get a driver to come on for Uber, if that driver is already driving for mobility, but they're not for delivery, it only costs them on average about $25 of marketing or incentives or whatever the case may be to get that person to be multi-platform and start driving for the other app. So again, another increased benefit of scale that a business like DoorDash, a business like Lyft, any of the international companies other than the few super apps in like South Korea and like whatever, none of them benefit from this. I should say none of Uber's direct competitors benefit from this multi-platform thing. It's a very unique competitive advantage within the Eats and Ride business. Here they talk about expanding their partnerships. I'm not going to spend time on that. In terms of the actual operating metrics of the business, we could run through them here. I prefer to show you guys over on FinChat, so I'm going to skip past a couple of these. The one thing I do really want to point out is to look at the variability in terms of constant currency revenue growth and actual revenue growth. So over the past handful of quarters that they've shown us here, it's usually been off by about 1%. This Q3, where it was a higher total revenue percentage, it was off by about 2%. And then if you look at today, even though it's a much slower revenue growing quarter, the delta between actual revenue growth and constant currency was about 3%, which totally makes sense for a business residing in the US. A weakening dollar, which we've seen over the past, since Trump took office, basically, a weakening dollar is absolutely going to be impacting the global business that is Uber. It's not specific to Uber. And so I don't really count this quote unquote slowdown in terms of revenue growth as that big of an issue, because I believe it's going to be temporarily in a Forex environment where everything is sort of stable and like trading within the usual ranges that it trades at. You wouldn't have this type of issue. Uber would be still north of 15% of revenue growth. And then on top of that, you have Q1, which is a historically weak revenue quarter. I mean, you look at Q1 of last year, for example, it was 15% growth. So is 14% versus the 15% growth of last year really that big of a slowdown, even considering the 3% headwind in terms of foreign exchange, right? So I saw some people complain. Jesus Christ, for some reason I forgot that word. I saw some people complain about the revenue growth. Oh, it's slowing down, whatever the case is. Surely means that AVs are impacting their business. It's not. But yeah, there's a lot more reasons going into the slowdown in revenue growth than what initially meets the eye. They now have done $7.8 billion of free cash flow in the trailing 12 months. For reference, that is more than Netflix. That is, even though Netflix is 3 times higher of a market cap, that is way more than Tesla, which is, like an $800-900 billion market cap business. And so in terms of profitability, for some reason people have, well, not for some reason, because it was a money-losing business for several years, people have a very bad taste in their mouth of what Uber used to be, and they kind of have this bad memory of this company from the past. It is no longer the case. This business is unbelievably cash generative, and they consistently are beating estimates in terms of, first of all, their own guidance of what free cash flow is going to look like, which they don't guide for free cash flow. They do adjusted EBITDA, and then you kind of work the numbers back, you land at a free cash flow number. But then on top of that, they're coming in way above analyst estimates. And I saw the same thing 2 years ago with Amazon and their free cash flow numbers, their operating income numbers, everything. Analysts, Uber themselves, they have a horrible time trying to actually predict operating leverage. It tends to be much higher, faster. These businesses can cut costs at a significant pace and then additionally raise margins. It's quite literally like a switch where you could just turn the switch off, or turn it on in this case, and you could become unbelievably profitable. In the case of Amazon, in the case of Spotify, Shopify, you add Netflix. Netflix is another great example of that. All these businesses, in a moment's notice, within 3 quarters, they're able to transition the business from losing billions of dollars to highly cash generative. In the case of Uber here, it has taken about 2 years. But I mean, you take a look at this, right? So over the past 2 years, they've gone from essentially break even in terms of free cash flow to now generating $8 billion of free cash flow. For reference, a Disney park costs about $2 billion of capex to build. So Uber has enough money to make 4 Disney parks per year. And they're still growing that, by the way. This is not the end. They're not going to stagnate at this point. They're going to continue to churn out unbelievable amounts of free cash flow. Now, the one little unknown feature that we have on FinChat is this little estimates chart. So this shows you the estimates, in this case, of free cash flows over time. What analysts think that in the year, for example, let's do 2024. This is in the year 2024, how much they expected that Uber was going to be doing in terms of free cash flow. So at the start of the year, once they started coverage on 2024 free cash flow, they were expecting roughly $4.4 billion in terms of free cash flow. Now you see this little bump right here. This is when Uber reported earnings. And so they reported earnings. And so the number got much closer to about $5 billion of free cash flow. I think this was another quarter here where they increased their estimates. And so keep in mind, we went from about 4 to, like 4.5 to about 5. And then over time, again, a couple quarters pass up. It's again increased to $5.6 billion in free cash flow. And then this was the biggest boost in terms of estimates, where it went from $5.8 billion to $6.3 billion of free cash flow. So from back here to here, this is a 50% change in terms of estimates for how much free cash flow Uber is going to be making in the year 2020 by the year end 2024. Of course, with only 1 quarter left, you have quite the clarity in terms of how much free cash flow there is. And so the average estimate was maybe about 6.3, 6.4, 6.5, whatever it is. Guess what Uber came in? They came in at 6.9 billion. So even the final quarter of the year, analysts were still undershooting how much free cash flow Uber was doing as a business. And I say all this to point at the fact that today, if you look at how much free cash flow is estimated for Uber to do in the year 2025, the average estimate is about $8.3 billion. If we go back over to the financials tab, in the past 12 months, they've done $7.8 billion. So we have 3 quarters left for them to, what is the difference there? Do about $500 million of incremental dollars. That's not that much growth. If I were to take a guess, I think by the end of the year, I'm going to make a video, I'm going to clip this, and I'm going to say that we are north of $9 billion of free cash flow. My God, was Uber cheap. Now, I say all this to say that when we pull in the forward price to free cash flow of this business, that is off of the assumption that they're going to be making, I keep forgetting, 8.3 billion in terms of revenue. Even with that, this is a company that is currently trading at about 15 times free cash flow. On April 7th, when it went down to $60 a share, it was trading at 12 times free cash flow. But even today, at the all-time highs that this company is trading at, with imperfect free cash flow estimates, the company is trading for close to a commodity multiple. I think Ulta Beauty trades at a similar free cash flow multiple as Uber. I'm not joking, right? I think Dollar General, again, similar free cash flow multiple to Uber. If we want to pull in, and then to make all of this, I guess, worse or to our advantage, actually, I noticed that there's a couple different things happening on the cash flow statement. So a big point of contention with Uber's quote unquote free cash flows is that they have insurance reserves on their free cash flow statement. And so it's up for debate whether or not you want to consider those actual cash. It is cash that has came into the business that they're keeping in on the balance sheet. It's completely theirs. They don't, this is the key, they don't use it for day-to-day operations of the business, but instead they have it as reserves in the event that they have to do payouts for insurance, right? So it's still their money. It's just they've put it aside and they're making interest off of it, and they're not using it for day-to-day operations. So my argument, being the hyper bullish Uber investor that I am, I argue that's fair game. That's free cash flow. You could completely use it, no problem. Other people, and rightfully so, I see your side of the argument, say that no, you got to deduct that from the free cash flow number. If you do, it doesn't look anywhere as good, right? Like 700 million off of 2.3 billion, that's a third of the free cash flow is gone. It's not the same for every quarter. Sometimes it's a little bit more, sometimes it's a little bit less. But it's a significant chunk of the free cash flows that are going to be gone if you exclude those insurance reserves. I tend to argue that that's fair game. So that's something to keep in mind. But nonetheless, the Uber management in Q3 of last year, they said that insurance reserves will go down in the first half of 2025, and then we'll see where it's at afterwards. And this has exactly happened. The insurance reserves slightly tick down. I think in Q2 they'll tick down even more. You're having the CPI prints for insurance come in. Last year was 4% up. This year it stayed flat. So there's a lot of data to suggest that insurance is either going to stay flat or down. Uber themselves are working with the state of Mississippi or Delaware, all these different states and whatnot, on a highly localized basis to actually bring these insurance costs down. So I would assume that this should be less and less of a headwind on a going forward basis, even though I disagree that it's a headwind to begin with. Now, the other incredible, actually, I guess there's another two things that I should mention here. Their stock-based compensation, despite the fact that their free cash flows are completely exploding to the upside, you have stock-based compensation, and I'll show this to you guys on a quarterly view, that is continuing to decline. Not only is it not growing proportional to the cash flows, but it's an outright decline. You can't really see the trend here. Here we go. I toggled different y-axes on this, so it might look a little bit weird, but as you can see, the free cash flows are going up into the right. At the same time, you have stock-based compensation that is starting to decline, and it is off the peak of 500 million. It's over the past, how many quarters is this? 8 quarters or so, it has declined by about 20% on a quarterly basis. Ridiculous, right? Sequentially, it's up, but compared to the same quarter last year, it's down by quite a bit. So you're kind of seeing that increased margin in between the free cash flow of the business and the stock-based comp. And then at the same time, they had this deferred income taxes, which if you look at the PE of the company and it's at 16 times earnings or 18 times earnings, that's not real earnings. They had a one-time tax deferral of $6 billion, which is a positive EPS event or positive net income event. In reality, that's not actual earnings from the operations of the business. I don't like to include that. And so that flows down to the cash flow statement as well. As you can see, deferred income taxes is negative $400 million headwind to the free cash flows. The reason I'm bringing this up is that if this wasn't the case, if we didn't have this deferred income taxes on the cash flow statement, the free cash flows in this quarter over the past 12 months would have been $8.2 billion. If you look at the estimates for the full year, for another 3 quarters that Uber was supposed to grow, it's supposed to, quote unquote, be at 8.3. So in my eyes, they've already achieved the free cash flow target for the year. It's 8.2 versus 8.3. You obviously want to deduct stock-based comp, but I say all this to say, with the current market cap of Uber on a trailing basis, you're looking at about 21 times free cash flow. Never mind the fact that they're probably going to be continually growing these free cash flows throughout this year and then a year after that and that type of stuff. The operating leverage thing I mentioned, they're going to consistently beat these estimates. It trades at about a 5% free cash flow yield today on a trailing basis, right? So I see all this to say, to kind of make the point that don't really be fooled by the fact that the stock is up about 40% year to date. Yeah, it would be nice to buy at a much cheaper valuation, but in my opinion, the stock is still unbelievably undervalued. I personally told the Discord earlier that I'm considering, because I have a little bit of cash. I think I have 4 or 5% cash still. So I was thinking like, okay, I might as well put it into this business. The thesis is playing out. The business is doing fantastic, at least from a fundamentals perspective, right? I have about 5% cash. So I'm debating putting 5% more and then slowly making it my biggest position, just because the company is executing at all levels and it is unbelievably undervalued. I think once it gets a re-rating to like north of 30 times free cash flow, the stock is up massively. Then people will actually start to pay attention and wake up to the fact that, oh, this is an incredible business in front of us. You would imagine that it's up 40% year to date and it would be expensive. But the thing is, the fundamentals are improving at such a accelerated rate. The fundamentals are actually in front of the stock returns over the past 2 years or so. So that's sort of my take on it. The one last thing that I want to cover here is using FinChat Copilot. It's very good at summarizing earnings calls and that type of stuff for you guys, so feel free to try it out. But what I'm going to ask you here is, what did they say about autonomous vehicles, to sort of get a summary into, what they said about autonomous vehicles. So they launched in Austin with about only 100 cars, and they mentioned that they're very highly utilized. Additionally, another thing that they said that made a lot of headlines was that the Waymos that are currently in Austin are busier than 99% of Austin drivers. What that kind of tells you is that, like, basically right away, as soon as you tap into the Uber network, your car is becoming 100% utilized. And so the thesis with AVs with Uber is that if an AV company is going to partner up with Uber, they have instant go-to-market, instant demand for their product, and immediately start essentially turning on the cash printer, right? And Uber, to some extent, is partnered up with these local fleet operators. I think they have like 50,000 fleet operators on their network. And so you, as a Waymo, can essentially make the software, make it work, whatever. You go to Uber, Uber points you in the direction of like a Toyota or something like that. Or like you yourself partner up with a car company, a Toyota, Jaguar, Volkswagen, whatever the case is. And then you guys build the cars, you put them on the Uber network, Uber connects you with a fleet operator, and then basically right away you have go-to-market. You have these cars that are 100% utilized throughout the day to get cleaned, and it becomes a runaway investment with immediate monetization. That's the thesis with Uber. If you want to go do it yourself, yeah, you could go do it yourself. But as we have data that showed, in the first 30 days of San Francisco versus the first 30 days of Austin, the average Austin Uber had almost double the monetization or the utilization of the San Francisco one. And again, it's early data. We're only comparing two cities. No two geographies is going to be the same. But I think this is a trend in the right direction. I think this is what we've been talking about all along. And intuitively, it makes sense that the app that the people are used to going to get a ride, if you offer them that, hey, do you want to take a Waymo ride for about the same price, most people are going to opt into that, versus you have to do a unbelievable amount of marketing to sort of market the actual Waymo app, or in the event of a Tesla, do the same thing. And, odds are that it's not just Tesla and Waymo that are going to be figuring it out. It's a bunch of different companies. As they mention here, Uber is collaborating with several AV companies globally, including WeRide, Chinese company, Pony. And by the way, the WeRide company, they've been doing AVs since like 2022. Like, it's out on the streets of China. In Beijing, they have them. In Wuhan, they have them. There's like 100 of them out on the streets. People can go to it. Apparently, it's become more of like a touristy thing, which I guess makes sense. Same thing with Baidu. Actually, you know what? I think it's Baidu, which is the Google of China, quote unquote. They have AVs that are on the roads, and they've been doing it since 2022, and they've been doing great. So you have all these different Chinese companies that have been doing this for a while. And so more and more, it's starting to look like that the thesis of Uber is going to be the demand aggregator is becoming more clear, because there's a lot of different AV companies, and it always made sense. There's never going to be just Waymo with 90% market share, just Tesla with their 100% market share, right? So it just doesn't make sense. Particularly with Tesla, I think they're having troubles just selling their cars, let alone, making a whole new business segment and having that go successfully. And frankly, they don't have the money to do it. They have a great balance sheet, but they don't have the free cash flow or the operating income to continuously be able to fund something like that. I just asked a follow-up question here. How are companies like Uber planning to integrate AVs into their services? Let's see what it comes up with. In the meantime, you can check out finchat.io using the link in the description down below. There's a 2-week free trial for it. We've been using it all video long, and of course, it's a great tool that I use very frequently. And so I'm not going to bother reading this whole thing just for the sake of time here, but it says that Uber's expanding into 15 new cities over the next 5 years. Wow. And then there's this company called May Mobility, which I'm not too sure what they are. Do they have a stock? What do they do? So this company is supposed to, oh, that is an ugly car. Yeah, see, I wouldn't really get into that, but they're supposed to be launching in, Arlington, Texas, by the end of 2025, with plans to expand to the US market in 2026. Similarly, Uber and Momenta plan to start operations in Europe in early 2026. So yeah, like I said, dude, you have multiple different companies. There's the Middle Eastern company that's doing it. And so depending on where these companies are based out of, I would guess that the European company is going to dominate in Europe. The American company, it's going to be a bloodbath. There's going to be a lot of people there. Same with China. You have the Middle East company that's probably going to have a huge market share there. But odds are they're all going to go through Uber. And what's interesting is over the next couple of years, I think this can turn from a headwind for the business to a massive secular tailwind for them, that they're going to be making massive amounts of revenues from in the future. So anyways, I think we have spent a good 20-30 minutes on Uber here. Let's move on to DoorDash. And I got to start getting quickly through these. DoorDash, it wasn't too interesting of an earnings report. I'm gonna find this Twitter thread I made. Actually, I should mention this. Something funny happened. So last quarter, Q4, the operator on the earnings call, she didn't realize she wasn't on mute. She kept stuttering and stuff like that, which nobody really like pays attention to. Like you wouldn't notice that she was stuttering. It's kind of subconscious, right? And then she didn't realize she's not on mute. And then she goes like, "What is wrong with me today?" So here, I'll play for you guys.
State your question.
Hi there. Thanks for the question. One for Tony.
What is wrong with
and
me
then
today?
one for
The analyst pauses. But yeah, she wasn't on the Q1 call, so she might have been fired or whatever. Point is, like, spotlight effect, right? So like, I'm sure nobody would have really noticed, or like, we're all human, that you're allowed to stutter and whatnot. It's fine. But as soon as she like called attention to it, you're like, oh yeah, what is wrong with her today? Right? So quite funny. Here we go. So I made this thread on how DoorDash is secretly becoming, bit clickbaity, the Amazon and Shopify of food delivery. It actually holds up, because if you go through their earnings, they plan to acquire 2 companies this quarter. I believe they agreed to acquire 7 Rooms, and the other company they agreed to acquire is a third place food delivery business in, I believe, just the UK. It's called Deliveroo, and it's not that great of a business. I would assume they're running unprofitably and that type of stuff. Once they come into DoorDash, they can be more profitable and whatnot. But anyways, the more interesting, in my opinion, acquisition they're doing is they're paying $1.2 billion for this company called 7 Rooms. And you're like, okay, what is 7 Rooms? 7 Rooms is a sort of restaurant-specific CRM, or customer relationship management. It's for the operations of a restaurant or hotel or that type of stuff. So this image here is sort of what it looks like. You can see all the people that are dining and that type of stuff. It seems like there's specific sort of metrics and that type of stuff in terms of each table and information about them. Some of the services that they provide, for example, is marketing automations and emails and text messages to like regarding your reservation and that type of stuff. You can do loyalty programs through them, reservation and waitlist tools, table management. I believe they have order taking as well. It would make sense that they do. And then they have huge customers. So like MGM Resorts. I think that's I'm starting to doubt if it's a hotel now. I think it should be a hotel, right? So anyways, Hyatt, again, another hotel, Marriott, another hotel, Hard Rock Cafe, obviously the restaurant bar chain sort of thing, Top Golf, which is kind of interesting, honestly, and then Live Nation as well. I believe they do concerts, right? So it's this software that is, it is a software. It's a software company that is used for these big enterprises and like restaurants and that type of stuff. Kind of reminds me of Toast, which is a pure restaurant software management operating system tool sort of thing. But yeah, if they buy this is the point I'm trying to make, where DoorDash specifically is leaning more into becoming not only the marketplace, which is like, for example, the Amazon, but also becoming the Shopify, which is the back-end sort of software that is used to run the day-to-day operations of your business. So like, if they're able to buy 7 Rooms and they're able to throw in a couple other services in there that is specific to like the restaurant, all of a sudden they become that much more sticky of a business for that restaurant, and it actually carves out a competitive advantage against an Uber, because that restaurant is more dependent on DoorDash, because they're obviously doing like, just deliveries and that type of stuff through DoorDash. But then on top of that, your whole back end is through DoorDash services and analytics and marketing tools and all this other garbage through 7 Rooms. And there's a huge amount of sort of cross-selling ability that DoorDash has. DoorDash obviously has, over 500,000 restaurants on their platform. So there's a huge amount of cross-selling ability that DoorDash all of a sudden unlocks. It kind of reminds me of actually Intuit when they bought MailChimp, because you could easily cross-sell MailChimp, which is a marketing tool and that type of stuff. It's like an email sending tool, with QuickBooks, which QuickBooks obviously use for small businesses, right? There's a huge amount of cross-selling that you could do right there. And so that means that if this acquisition goes through, as a subsidiary of DoorDash, 7 Rooms is going to explode. It's going to be a massive, massive business, but basically right away, because they benefit from the distribution that DoorDash has. And then the other point, which takes it a layer deeper, is that it would benefit DoorDash in a couple of ways. Yeah, they become a stickier customer, and that's great. Obviously, we want that as business owners of these stocks. But then additionally, those restaurants, and this actually goes back to the QuickBooks data, where, if you're a small business and you go on QuickBooks, you actually have higher business survivorship. But if those businesses start implementing 7 rooms into their restaurants and that type of stuff, that will make them more efficient, be able to get more sales, be able to have more information and make adjustments and cut costs wherever they see and that type of stuff, and just overall become a more efficient business, a better business, and as a result, be able to increase the sales of that restaurant in of themselves. And I'm not sure if you're aware, but DoorDash takes a percentage of your sales as a restaurant. They take about 13% of each DoorDash delivery. So if that business in of itself is thriving and becoming a better business and, making more revenue, that'll directly benefit DoorDash, because they are also taking a percentage of that revenue and benefiting off the success of that restaurant. So I think this is an incredible acquisition. I would way rather them do 10 of these acquisitions, burn a shitload of money, no problem, than to go buy Deliveroo, a third person, or the third place in UK. They're optimistic of that. I'm not very optimistic of that. I don't think you can buy a subscale business and try to make it bigger and that type of stuff. I don't care how much money you throw at it. And these are often in markets that are like pretty decided. Like I mentioned, Uber just gained category position in the United Kingdom. So you're really going to go start a price war with Uber in the UK when they have so much steam and they've already become the go-to place in the mind of those people. When people in the UK think of getting food delivered, they think Uber Eats. They've become the default destination of getting food delivery. So you're really going to go fight against that? Seems like a losing battle. You're buying the business for $2.3 billion. You're going to go spend a bunch of money on top of that with advertising, marketing, and then back them. And that, in my opinion, doesn't make sense. But there's another argument to it where consolidation within the industry should result in these companies looking for profitability and looking to make these businesses efficient. So perhaps there's an argument to be made where it actually reduces the price wars and that type of stuff, and it makes all parties more profitable, right? But anyways, 10 times out of 10, I 100% support this type of offensive acquisition, sort of using your distribution as a business to horizontally expand your product line and be able to sell the same customers new products, or new, in this case, sell them a CRM, right? So it's, in my opinion, a great acquisition. And that's why I say, it's becoming both the Amazon and the Shopify in this story, both the marketplace and the operations platform behind the scenes that the business runs on. One last thing before we move on to Shopify, funnily enough, I would love for any of you, if you're watching it this far through, by the way, thank you very much. Why do you guys know why DoorDash has higher gross margins than Uber? I think it has to do with the mobility business, the freight business being a very low gross margin business. That's why it ticks it down. But for example, DoorDash has 50% gross margins. Meanwhile, Uber has, I think, high 30s%. So I don't understand the delta there. I would assume the mobility side of the business is actually higher margin than the delivery side, just based off the take rate. I'm making that assumption, but I'm not sure exactly. So I'd love if any of you have the answer to that. In terms of sort of like a quick sort of valuation on DoorDash, it's kind of hard to say. Again, we can do price to free cash flow, EV to free cash flow. They're not quite free cash flow optimized. I think the better method of valuation that I like to do is EV to gross profit, which of course has its flaws, but I think it's a more consistent method of looking at DoorDash over the years. And so if we look at particularly since 2021, maybe it's on the higher end. But again, like you kind of notice this, especially with price to sales, just because the price to sales or EV to gross profit is going up during this time period doesn't mean the business is getting that much more expensive, right? Like you're going from 4 times gross profit to 12 times gross profit. They're also growing gross profit at a significant rate in the meantime. This is because the market is shifting the way they value the business from sales or gross profit or whatever to operating income, free cash flow, and like a line lower, you know what I mean? So it's a bit difficult to value at the moment. Maybe another way I could value it is to assign it like Uber's free cash flow margin and just call it a day, which actually makes me curious. What is their free cash flow margin? So this is interesting. They have about 18% free cash flow margins, which Uber has the exact same thing. They also have 18% free cash flow margin. Interesting. So it seems to me, at least, that DoorDash is a significantly more expensive business, perhaps due to the fact that I guess they have less of an AV risk. That doesn't make too much sense, right? So Uber today trades at about 20 times cash flow. you get the mobility business, you have a globally diverse business, whereas DoorDash in particular is mostly concentrated. Yeah, they have 90% of revenues are within the US, right? So you have a much more concentrated, maybe that's part of the competitive advantage. I'm not sure. At the same time, Uber is multi-platform, right? So you have delivery, you have Uber Eats, Uber Mobility, but I'm not sure why it trades at that much of a premium. I'm personally, 10 times out of 10, I would pick buying more Uber than buying DoorDash, although I think DoorDash is a phenomenal business as well. It's quite similar to Uber, obviously. But yeah, those are pretty much my thoughts on DoorDash. Now, moving on to Shopify, and we'll keep this one brief because there wasn't much to talk about it. They did great on their earnings. Actually, I'm going to go over to the FinChat page. So, I mean, in terms of just pure results, like this was a great quarter. Revenue came in at 27%. I think they guide for like a mid-20s rate. So that was great. Operating income, 136%. I think that's a good chart to pull up later. The other KPIs, again, it was like north of 20%. It was good overall. So in my opinion, was business as usual. They missed slightly on their EPS and their revenue was actually perfectly in line. I think it was a great report. The stock slightly sold off, I think partly due to the fact that obviously it's quite an expensive business. So what is the delta there? That is about 500 million more in revenue. So that means that I think they did about 9.3 billion in revenue. You have a market, and actually, so the stock was down about 7-8% earlier today. It's only down 1%. I think rightfully so. It was a great quarter. I don't think the stock should be down. But you take a 117 billion market cap and we divide that by, roughly 9.3 billion of revenue. This is a company that still trades at about 12 times EV to sales on a trailing basis. So I previously said that 12 times EV to sales, I think, is quote unquote a fair valuation for Shopify. It's definitely a very expensive business. There's no discounting that. But I mean, you look at where it generally trades at post 2021 bubble, it's about the average. And this hasn't updated yet, by the way, because CapIQ data hasn't came in. But about 12x sales, EV to sales is about the average post 2021. Obviously, you spent a good amount of time below that. It got as expensive as 18 times sales in February. But if I really didn't have any other better options personally, I would probably do like a starter position around the 12x sales mark, which I guess now it's trading at once this updates. Quick shout out, by the way, to I think it was honestly probably one of the best videos I've ever made over on the Discord / the Patreon. And there's a free trial for this, by the way, which you guys are more than welcome to just free trial it, go watch the video and then unsubscribe. I don't mind. But I did a deep dive on Shopify. It was quite a long episode, and we went through the whole thing. I thought it was a great episode, really highlighted how strong of a business this company is. And I think some people just kind of forget about Shopify. But I really think it has potential to be a $1 trillion business. You call it 10, 15 years down the line. I wouldn't be surprised if it's a $1 trillion business. It's a company growing within the mid-20s revenue growth. And they have a huge runway of growth. These are sticky revenues. It's a mission critical business. Just overall, just an incredible business. I do plan on eventually making this video public with the permission of the members in the Discord. After some time passes, I'm going to make this video public, probably sometime after earnings season. But anyways, there's not much to update here. I guess a cool custom metric I made a little bit ago is was it this one? Was it take rate or revenue take rate? Because it's a two-part business, right? So about 20% of the business is the subscription they make, where they literally just charge you $30 to even have Shopify, or it goes up. It's different pricing tiers. And then the 80% of the business, so technically the more important part of the business, they take a percentage of whatever it is that you're selling on the Shopify platform. And so it's not as easy. That's why there's this gross bookings number in the KPIs, by the way. It's not as easy as taking the revenue, dividing it by the gross bookings, and calling it a day, because you have that subscription revenue, which is kind of independent of your gross merchandise value. So what I did with this take rate calculation is I simply took merchant solutions, which is just how much that variable portion, how much they're taking as a percentage of whatever it is you're selling on Shopify. And I divided that by the gross merchandise value. And you could see, I didn't even consider this, but this is a huge point of operating leverage for the business, is that over time, they're probably doing this to a small extent. They're probably doing this on purpose of increasing prices against their sellers, because, they can't really do anything. But this is huge pricing power in the sense that over time they're quote unquote increasing this take rate. I think what is more evident here, I don't think that's the right word. I think what's actually happening here is that the average merchant is on some sort of a plan or in some capacity is generating these revenues at a higher take rate for Shopify, because it's not like a straight take rate, right? It's like, if you're a coffee shop, you're selling $2-3 ticket items, they take like a fixed 20 cents or like a fixed 10 cents, whatever it is. So obviously, depending on if you're selling a really expensive item or a small ticket item like a coffee or whatever the case is, then that changes the equation in terms of take rates. And so I think you have the duality of both. They are actually increasing these take rates over time, but then at the same time, you have these businesses coming on where the take rate, because of that fixed 10 cents or whatever it is actually becoming a higher net take rate across the business. I hope that made sense and it wasn't alphabet soup. I think you guys get the idea. But point is, great points of operating leverage for the business, independent of the revenue they make from subscriptions, which brings me to my next point. How much revenue are they making from both those segments, and how fast is the growth? Merchant solutions, which is basically a fancy way of just saying they make that 2% off of whatever it is you're selling. That is the faster growing and bigger segment of the business, but it's more prone to a down cycle. If we have a recession or whatever, if people stop buying stuff online, then that's going to be impacting Shopify. You'll see that come in with the numbers. In good times, when people are spending a boatload of money on Shopify and just online shopping and that type of stuff, you'll see that reflected in the numbers, as it is in the past 2 quarters. You're seeing 30% growth. That's a result of people spending more online, right? And then you have your subscription solutions revenue. This should stay mostly flat depending on a slew of factors. This will move around, but this is supposed to be the more high margin and consistent segment of the business. And again, it also shows in the numbers. So if I could demonstrate this to you. Oh, Jesus. Wait a second. Okay. The subscription portion of the business, so how much you pay just to have a Shopify store, that only makes up 24% of revenues, but it makes up about 40% of gross profit. So it's a result of having higher gross margins on that part of the business. But yeah, I think that's a pretty decent overview of the quarter. Business as usual. There's nothing to highlight. This is one of those companies that I think once eventually I buy into the business, which I do plan on eventually opening a Shopify position. It's a fantastic company, but it's one of those businesses that you don't really need to check up on. If in the event that merchant solutions, it goes down to 10% growth, whatever, probably a one-off quarter. It's probably maybe like a 1-year event, depending on consumer spending. They are, at the end of the day, prone to those oscillations in the economy and that type of stuff. But at the end of the day, if you're bullish on consumer spending, online particularly, Shopify is going to benefit from that, which you look at historical growth rates and projected growth rates, that's going to continue. And I should mention while we're here, Shopify is a bit different from something like Amazon, for example. You go to Amazon because they have a boatload of demand already there. You go there because Amazon already has the customers. You go to Shopify to build your own brand and to be able to bring customers to you, the brand, if you're like Gymshark or something, right? And so it's like a different sort of thinking and framing in terms of how you're going to be reaching the end customer. In the event of Shopify, you're trying to create a brand. When you're going through Amazon and you're selling something on Amazon, you're simply trying to access the 200 million Prime subscribers or whatever it is, right? So people often compare the two. It's slightly nuanced and they're slightly different. I guess you could technically think of it as a percentage of just online commerce, which I guess that works, but at the same time, in terms of ultimately the person that is selling the product, which to some extent is the customer of both of them, it's a difference in framing, right? And I would assume there's little overlap between the two. Anyways, we are, at least on the recording, we're about an hour and 7 minutes in. So again, I highly appreciate it if you're this far into the video. I did want to make this just a super long video and just upload it because we have a lot of news to get into. I didn't want to make a bunch of videos and that type of stuff. Whatever. Moving on. Amazon made headlines, and we'll spend very briefly on this, where they unveiled this new robot called the Vulcan. And the reason why it's special is because this is the first robot in the world that has a sense of touch. Now, me personally, when I hear that, I get a little bit creeped out, because what does that even mean, that it has a sense of touch? So it knows when we're touching it, or it knows like, can you shake hands with it, right? So I'm not going to go through the actual blog post because it's a whole lot of blabber, but CNBC, which, political stuff aside, you could say they're biased, whatever the case is, their business videos that they make is very entertaining. Like, it's a great production. Oftentimes they're actually going directly to like the person responsible for that segment of Amazon's business. They're doing like a mini interview with them. Of course, they stitch it up and whatever. And like, I guess they're giving you a opinionated look into whatever opinionated look into whatever the video it is that they're trying to show you, or whatever the topic is, particularly some very like anti-Elon videos. But the point is, if you haven't been watching CNBC or Wall Street Journal business videos in specific, I would highly recommend it. They're very, very entertaining. But anyways, here we'll have the guy that actually came up with this literally explained to us what it is that they're doing, right? I'm going to slightly speed it up, by the way, just for the sake of time here.
Vulcan is a 3-part system. An employee puts an item from these yellow bins onto a conveyor where it's picked up by the first part, a moving robotic structure called a gantry.
Which is a robot that moves horizontally and vertically. We'll take that bag of Skittles and put it into our buffer wall. It waits there until the robot makes a match. So the robot brain is looking for an opportunity where it can create enough space to put that bag of Skittles.
Next, it's picked up by this robotic round foam disc.
We affectionately call that the squash turner. So it reorients the item, kind of like it sounds. Things like books where you want the titles facing out, or things where you need to align it so that it'll fit in the space.
Finally, the item is picked up by the gripper.
It has conveyor belts built in, and so the item feeds forward and backward. So the gripper has a sense of force on its grasp axis as well. So we don't squeeze a bag of Skittles as strongly as we squeeze a physics textbook.
That precise amount of pressure and torque is determined by an AI-powered sensor. This is the sense of touch that until now, experts say hasn't been put into commercial use in robotics.
The other thing that's super cool here is this guy. It's an extended sort of spatula, and the force sensor, the thing that we're feeling the world, sits right behind here, right on that spatula.
This new ability to adjust pressure means Vulcan can handle up to 75% of the 1 million unique items in inventory here in Spokane. Amazon's Sparrow robotic arm can handle some 60% of items, while Robin and Cardinal only manipulate packages.
We're also using generative AI to predict how the items are going to move. So if I push on the t-shirt, is it going to compress? Versus if I push on the bowling ball.
Vulcan's final step, finding the perfect spot to stow the item, adds some major efficiency gains for Amazon.
One of the use cases we have for AI is predicting how much space we can make in a bin, and then taking the right item that maximizes the filling of that predicted space.
So a bit like Tetris.
It is a bit like Tetris.
And so there you have it. Amazon has been an everything play. The everything store has been an everything play. It's a play on online commerce. It's a play on cloud computing. It's a play on AI, robotics, you name it. If it's under the sun, Amazon is probably doing it. Satellites, that's another thing they're getting into. So it just consistently remains to be just such a consistent business in terms of investing into new innovations and literally doing everything. And this just goes to show this is a continuation of that. They just mentioned a number, 75% of the items in Amazon can be handled by this new robot, and it knows exactly, based off generative AI, it's able to predict how much pressure should I apply to this item based off of those sensors that are able to see, like, okay, this is a package of Skittles. Apologies, I just got a phone call, but like I was saying, basically, this is just a continuation of this business showcasing the strength that it has with all these new verticals and being able to drive continuous efficiency across the business. So when they're investing, and this is just pure scale that they're able to do stuff like this, right? So when they're investing in cloud computing and putting all that capex to train their not tranium chip, but they're making these tranium chips so that they can make AWS a little bit better. It shows off in other parts of the business. And it just so happens that Amazon's biggest AWS customer is Amazon themselves with the online retail and that type of stuff and stuff like this, right? So it's just an incredible company. That's all I got to say. It's an incredible company, which, you know, there's a reason why it makes up 33-ish% of my portfolio, 31% of my portfolio, right? Like, regardless of what you think, this is a company that is in so many different verticals and they're going to succeed and drive more scale and drive more efficiency. It'll translate to margin expansion, right? So just truly incredible stuff. I'm going to link this video in the description if you're curious to watch the whole thing, but I thought it was quite interesting. Thought I should share with you guys. Moving on. Finally, we have, or no, I think I was supposed to go over HIMS after this as well. Jesus Christ. Hour 14 in the recording here. So Google. I think I'll save it for like a longer sort of Google specific video, but the point I was trying to make with this is that everybody's very quick to say, oh, ChatGPT is taking share from Google. Surely Google's going to go to zero because everybody's going to switch over to ChatGPT. I think that makes a couple assumptions, which I disagree with. I think there's probably a decent chance where a large enough number of us are going to switch a good enough portion of our searches over to ChatGPT or other LLMs where it's going to materially impact Google. I think it's become obvious that is something that's likely going to happen at this point, right? And AI overviews, as great as they are, they're not going to prevent me, and I've seen it in my own user behavior of searching, where if I don't get the answer with search, I'll go over to ChatGPT, or altogether, there's new prompts that I'm able to give to ChatGPT that search could never, right? Search is good for searching up information. ChatGPT is good for me plopping my thumbnail in there. Hey, what do you think of this? How can I improve it? That's not an answer that AI overview or search is going to be able to give to me. Even if I pull up forums on like Reddit on like specific stuff, it's just not going to help, right? there's the added benefit of like, you can put images into ChatGPT. Hey, what do you think about this? Hey, what is this email telling me? Hey, what are these instructions? Summarize these. So it's all these different new types of searches that we're able to make that you just can't on search, right? And that's going to hurt search volumes without a doubt. The issue is that, and I'll pull this up. Okay. Well, you know what? We'll come back to this number. The first issue is that as of literally 2 weeks ago, OpenAI reiterated the fact that they are not going to be doing advertising. And that makes sense for like 10 different reasons. But the main reason being that advertising is definitely an inferior business to subscriptions. Subscriptions are reoccurring, very predictable. You can calculate retention rates and know exactly how much money you're going to be making. It's just a superior way of conducting business. That's why every company in the world, including Uber, is going from variable transactions, being the number of rides that you're doing, to having subscription revenue. Subscriptions are high margin, superior in every way. I don't have to tell you guys that. You guys already know that, right? So they have no plans of doing advertising, and they have no current plans of doing advertising. Same goes for Perplexity. Perplexity is known for being like free and ad free and that type of stuff. That's actually the selling point of Perplexity, because they're sort of this like anti-search, anti-Google, especially if you listen to the Perplexity CEO and the way he talks about that type of stuff, right? So they have no plans. At least that's what they're saying, right? And so the issue arises in the fact that ultimately, who is the customer of Google search? I want you to think about that for a second. Who is the customer of Google search? Is it us who are consistently on Google searching away? Not really. We're the users of Google search, but ultimately the person that is making the money for Google are the actual advertisers. It's Nike when you search up running shoes. It is Samsung when you search up QLED TV, right? So it's all these companies that are actually buying these sponsored listings. Those are ultimately the customers of Google. And I bring that up because in order for the imaginary scenario where we all start moving away a good amount of our searches to ChatGPT and that type of stuff, and that starts to impact the queries, where are the advertisers going to go? 40% of global digital advertising, 40%, that's almost $1 in every $2 spent on digital marketing is on Google. And then it is a smaller portion, specifically search and advertising. I think it's a number closer to like 27, 28%. Still doesn't matter. That's a quarter of the world's digital advertising is conducted on Google search. So my question is, if en masse, everybody starts to switch over to ChatGPT, not overnight, but we start moving a significant portion of our searches and our queries over to ChatGPT, where are the advertisers going to go? They don't have an option. ChatGPT is quite clear in their messaging of saying, we do not have plans of advertising. Perplexity, that's their whole shtick. The entire existence of Perplexity is that we are anti-Google. We're not going to do advertising. We'll give you like a higher level version of our AI model, and we'll go with that. You can pay for that as a subscription, but we're not doing advertising. Advertising is annoying and whatnot, right? So that's like the entire existence of that company is anti-advertising, right? So if you're Nike, right, and you're spending, or if you're Booking.com, you're spending $5 billion of advertising every single year on Google search for people to search up Hawaii golf getaway, your Booking.com link comes up as the first option there. If you're spending $5 billion on that type of stuff, even if the searches stay roughly flat, even if Google increases the prices on you a little bit, even if it starts to decline, maybe you cut back on your budget a little bit, but like, what other option do you have in terms of advertising? Where else are you gonna go? Again, we're not talking some small numbers. We're talking anywhere between a quarter to maybe about close to half of the digital advertising of the world is conducted on search. Where are they gonna go? Where are the advertisers gonna go? Even if the number of queries starts to decline from, I believe it's like 5 trillion down to like 4 trillion, right? That still, the revenue is not going to disappear overnight. That's the point I'm trying to make. And I think it'll disproportionately go down. I think if you lose 25% of queries, you might only lose about 10% of advertising dollars. So I think in the event that Google search actually starts to decline, which is very possible in the next 5 years, I think that might actually happen. We had FinChat KPIs that came out on this. In terms of, let's pull them up here, paid clicks, which I wasn't actually too familiar with this, but there's 2 ways where Google search can actually grow. The first way they grow is that there's more queries, so they obviously do a higher number of queries, there's more ads served, and so they grow through that. And then the second way they can grow is through price increases. So the paid clicks portion of it is that volume growth of advertising, and that only grew about 2% year over year. And so on a surface level, you're thinking like, okay, isn't that bullish? They're still making the same amount of revenues, but with less amount of clicks, with less amount of ads served. That's bullish, right? not exactly. This is early signs, and I think you know what, we'll pull it up on charting tab. But I think these are early signs that, yes, searches are actually moving away from Google. I mean, this is quite an ugly trend over the past little bit, particularly because it's pronounced because 2021 was a blowout year. But, you know, since ChatGPTs came out in Q3 of 2022, actually right on the dot, you could kind of see it, but things have consistently gone down in terms of paid clicks, right? So they're still growing through price increases of those ads, and this is another thing I covered with Meta in particular, and that's forever going to be a thing because digital advertising, people are just going to consistently bid higher and higher for Google's advertising. But I think this decrease down to like 2% and perhaps into the negatives goes to show that this isn't a business that is immune to search volume actually declining, right? It's very possible, it's likely actually at this point, right? But going all the way back to it, even if this starts to decline, I believe, and perhaps this is optimistic thinking, that those advertisers will stay for much longer than people imagine, which I'll do a very detailed video in terms of my scenario of if Google was going to decline or if search was going to decline, what would that look like? I kind of did like a half analysis of that over on Twitter, which I got a lot of shit for it because people were saying 15 times sales for Google Cloud is quite aggressive, which debatable, but I think you're kind of missing the forest for the trees there. I'm saying even if you drop this like 12 times sales, right? That'll be, what is that, 600 billion in terms of valuation. Just the simple fact that we're talking about Google outside of their main line of business, the market cap still kind of works. That's ridiculous, right? You have these much smaller segments. So basically what we're saying is if we strip away 60% of Google, the market cap still kind of makes sense. That's the argument we're kind of making here, right? So just to kind of show you like how undervalued this business is, I think there's and I'll do this in the big detailed video, there's an argument to be made where just the cloud portion of the business in 6 to 7 years from now is worth today's market cap. Frame that sentence another way. What we're basically saying is that over the next 6 to 7 years-ish, roughly, you won't lose money on Google just because the Google Cloud segment of the business is going to grow. So the stock, in theory, will remain flat over the next 6 years just from Google Cloud. So if there's anything left in Google other than Google Cloud, you know, you got Waymo, you got DeepMind, whatever YouTube is looking like at that point, whatever search is looking like at that point, if any other component of the business exists, that's upside. Right? So my point is like you won't lose money on Google over the next 3 years. I'll put that in the detailed video how the math works on that, but I guess just for now, take my word for it. But in this scenario in specific, we said 15 times sales for Google Cloud, which seems aggressive, but I kind of explained it here. I said, what would you pay for an oligopolistic company where each incremental dollar of revenue is effectively 100% reoccurring? They currently grow 30% per year and have possibly decades of growth ahead of them. All the while, peers like, for example, AWS, Microsoft, that type of stuff, they have 40% operating margins at scale. And so Google is obviously eventually going to get there. What would you pay for that company independent of Google? And I really don't think 15 times sales is that aggressive. You have a business that is just spitting cash. It's mission critical. Every single dollar of revenue that comes into the Google Cloud business, it probably stays there unless that business goes bankrupt and they just lose their contract altogether, right? So it's such a sticky business. It's such an important company. They have such a massive secular tailwind of the internet growing. So I mean, just the cloud side of the business alone, and then you add on YouTube with YouTube Premium, you're looking at about 70% of today's market cap. And so I bring all that to say this search business that is probably going to start declining, even though it's currently growing 10%, by the way, might I add, you're only really paying about 2 times sales for that. And like this is for sure like north of 50% operating income. So you're paying maybe 4 or 5 times operating income for the search business. That's what you're ultimately paying for Google. You're paying maybe 7-8 times earnings for the search business. That's how cheap it's being valued at. I guess it is. It's being valued at a point where the expectation is that it's going to decrease and become smaller and eventually stop existing. That's how Google search in particular is being valued currently, which might happen, but I'm willing to bet that it probably wouldn't happen because AI overviews outside of LLM specific queries is going to do a phenomenal job for most of the world, and people are going to keep their queries on Google search. But then even in the event that it does start to decline, the valuation still more than makes up for it. Google is that unbelievably cheap that the valuation has more than priced in the fact that Google search is going to decline. That's kind of the point I was trying to make with that. But again, I'll do the detailed video with all the numbers and that type of stuff. But yeah, as you can see, the tweet did quite well. 260K impressions is quite a decent bit, particularly from my account. I got a lot of flack for saying 15 times sales. Oh, another thing, they have, $100 billion of cash on the balance sheet. So that even brings the market cap lower. Then you add in that they have a full equity portfolio of like about $50 billion. You have like a $25 billion stake in SpaceX. There's a couple other investments that are ingrained in there. You have the Anthropic investment. You have just a bunch of stuff that doesn't really meet the eye. You know what I mean? So overall, I think it's unbelievably undervalued. I say all that, and I'm still not going to be buying more because I already have about 20%, or I guess 18.5% invested into Google. So I already have like a pretty full position. I don't necessarily feel the urge to continue buying into it at this time, even though it's very cheap. I already have a massive allocation towards it. And so I'm riding through this with you guys. Now, with all that being said, we'll do a quick review. I bought into Hims and Hers Health, which I'll also do a detailed video on this at a later date, and I got unbelievably lucky with the timing. I bought it the day of earnings after hours when the stock was actually slightly down, and I bought at 41.20 cents, and then the day after, the stock rocketed up $20. Just for proof, in case for whatever reason you don't believe me, here at 5:08 p.m. on the day of the earnings, I said that just bought 27 shares of Hims. Watcher position, just like the many other watcher positions I've done in the past. Zero chances will be in my portfolio long term, but I'll do a video and talk about it as per the usual stuff. And so that's kind of my attitude towards it. It's obviously nice that, I've made, like $300 or whatever it is in the past couple of days since becoming a shareholder, but the fundamentals of this business are truly remarkable. And I'll just go over to Twitter to better see these. By the way, this is quite a neat trick you can do with Twitter, is you do from the user's at and like the ticker, or like you could do, if you know a specific word, for example, like fastest, you can also include that. And then I think you do like minus filter replies or something. And so it gets rid of replies. There's a couple of neat tricks you could do with Twitter search, which are quite nice. But here we go. The main reason that, when I made this chart and I was thinking about it a little bit, I was like, okay, I have to participate in this in some capacity. Unless they're literally committing fraud, which I highly doubt. It's a US listed business, and I'm sure they do their financials properly, right? Like, this is a publicly listed US company. I'm sure they do okay, right? They just clocked the highest revenue growth quarter in their history since going public in 2021 or whatever it was, right? And what's interesting about that is that they're now, I think, close to $2.5 billion of revenue. So it's not a small business. $2.5 billion in revenue is, oh my God, I think that's on par with Palantir, actually. I think Palantir is like about 3. Wow. So yeah. Okay, Palantir trades at a 300 billion market cap. This is only 10. Different industries, different companies. Obviously, that one's super overvalued as well on top of that, but just to give you an idea. So yeah, they're at like $2.5 billion of revenue roughly, and they're growing at about 100% year over year. And what's more important is the trend of how fast this revenue is actually accelerating. Now, this is probably going to be short-lived. They have a huge pull forward in terms of GLP-1 revenues, which is affecting this. I would assume this drops off into 30% within the next 18 months or so. I highly doubt that they're able to keep raising this, keep accelerating this revenue, or even maintain it at all. I may be wrong, but that's not why I invested into this company, not for those expectations. The valuation works, even though I think their net margins are like 6% or 8%. Okay, 9% now. But yeah, like this is not a business that's optimized for margins at the moment. 6% operating margins, I guess 14% free cash flow margins, right? But despite that, like even on those ratios, it still doesn't trade at like a crazy valuation. It's 70 times earnings is kind of crazy, but again, consider they're growing revenues 100%. Even if revenues were growing 30%, it would still make that valuation work. Price to free cash flows looks even better, about 47 times price to free cash flow. A good bit of it is stock-based comp, but that'll start to normalize over time. And then more importantly is the KPIs of this business. They have some of the most beautiful charts I've seen since like the likes of like Shopify or even Uber. Actually, Uber, I like their charts as well, right? So for example, you have Hims and Hers, the number of subscribers they have, which I guess I should have mentioned if you're not familiar with the business yet. It's like a telehealth company. So you subscribe on a monthly basis to get like your hair loss pills or whatever, or for example, you get your thyroid, is it? Yeah, you get like thyroid pills or whatever the case is. And so this has slowed down, and rightfully so. You have like 2.4 million subscribers, but as you can see, it's just up and to the right without fail. Now, my issue with that is I want to know what the retention on those subscribers are, which they don't break it out, but I wouldn't assume it's good. I think people probably subscribe for like 8 weeks and then they're just off. So this is high levels of new customer acquisition that they have to consistently do every single quarter. They have to keep doing a boatload of marketing to consistently get these customers and that type of stuff. But I would assume over time that they're able to cross-sell like a whole bunch of different health items and just keep that person subscribed. That part of the thesis, I just haven't done much due diligence. And honestly, it's a 1.5% position. So I'm not exactly at a stage where I'm figuring out all the edge cases in terms of the thesis with this business. Another unbelievable chart from this business is, yeah, sure, the number of subscribers is slowing down, and I guess that's kind of an issue. It's still growing 40%, by the way. But the average revenue per subscriber is just completely skyrocketing. As you can see, over the entire time this company's been public, it's hovered between 50 to like 57. It seems like it's seen mild growth, but then you can see in the past 3 quarters, it has just completely exploded upwards from $57 to $84, and it's up 53% year over year. So the average Hims customer is basically transacting about $84 with them monthly. And this, again, kind of reminds me of like the Uber type of companies where like there's a bunch of different ways that you can pull on incremental growth. You can increase basket size of growth with delivery in particular, right? You can increase basically the frequency of how much they're transacting with. And so there's a lot of these scale advantages that I've picked up on in other great businesses that I think applies to Hims. And so Hims is a much younger company. And of course, you have over on Twitter all these people that are like, yeah, it's a 100x opportunity, this and that, whatever. I'm a little bit more calm with my expectations. I don't think it has to be a 100x opportunity for it to be a successful investment. I think they just keep executing. They keep growing revenues. They keep bringing on more subscribers and that type of stuff, and it'll be a successful investment. There's great questions in terms of what is the moat of this business? Why can't another company just spin up another Hims and build the logistics behind it and that type of stuff, other than the fact that it takes a couple years to do all that and do the marketing? They don't have a moat. They don't really have a moat. Realistically, any company can start to replicate them and become a competitor. So that's why, obviously I didn't make this like a 5-10% position. There's definitely risks to this, but I think they're an early mover in a big secular category. And then they have that requirement of like, it reminds me of the Netflix. It reminds me of the Uber, where they're replacing a very slow, redundant system in the sense of like pharmacies, essentially. They're doing it for cheaper, way less overhead. And then at the same time, like, one of the things the CEO said, was it the CEO or it might have been Martin Shkreli or whatever that guy's name is, where he's like, yeah, like, why do you have to go to the doctor every month to pick up your medication? Why isn't that just shipped to your house? We have like Amazon and that type of stuff today. So actually Amazon's another quote unquote threat to this business, right? So that really struck home because for example, my dad, I think he takes some stuff for his like thyroid or whatever that he has to. And like, why does he have to go to the pharmacy every single month to get a refill on his thyroid medication? And at the same time, like, these are like 80-90% gross margin products that the pharmacy is selling to them, right? So Hims, which is also an 80%, right? Yeah, 80% gross margin business. Over time, as they cut down on their sales and marketing, which I think is like half of their revenues is spent on SG&A, something ridiculous. 65% of revenues, or okay, it slightly declined, is spent on SG&A. So obviously, over time, that's going to tick down as a percentage of revenues, and you're going to see that operating leverage with this business as they become a bigger and bigger business, get more scale, get more word of mouth marketing going, and raise their brand awareness and that type of stuff. So like the margin growth is just, I don't even doubt it for a second. But yeah, they have just natural counter positioning against pharmacies to just be able to ship it to your house. It's more convenient. 100% is going to cost much less because, again, you have less overhead and that type of stuff. You could pass those savings on to the customer. And the CEO, he is a little bit more on the Alex Karp, Mark Benioff, Elon Musk camp, where he's constantly selling the stock and the business, that type of stuff. You kind of have to do that at the beginning, right? Like, I don't mind that he does that. But like, for example, he compares himself to like Netflix. He's like, yeah, we're building the Netflix of healthcare. That's a bit of a red flag for me because I think the smallest dog barks the loudest is the saying. So for example, Elon Musk consistently saying, yeah, we're going to become the biggest market cap. We're going to become 5 times bigger than all of big tech. Like, what are you talking about, right? So he's compensating for the fact that Tesla has piss poor results for the past, call it 3 years. They've had horrible results. The deliveries are just completely in the garbage. The revenues are declining, all that type of stuff, right? So he's compensating for that. But I think this is backed up by the numbers. I think they benefit from, as I mentioned, a lot of scale advantages that I've picked up on across my studies of other different businesses. And so I wanted some exposure to it. I haven't fully fleshed out the research, but I did like a 1-2% position. And so we'll see where it goes. No expectation of me being in the stock long term. If there's something that I really don't like about the business, I'll sell out no problem. It is a 2% position. I'm giving that permission to myself up front. Yeah, that's about it. I'll do like a proper update in terms of the video for you guys later. Also, portfolio so close to 100K CAD. We'll do a proper portfolio update as well. I think another idea for a video I have is to sort of go through each business and what it would take for me to sell them. This was, by the way, another mention from the Discord, because I have a channel in here of video requests. So I think somebody mentioned it here. Anyways, if you made it all the way through, before you click off, you can come hang out with me using the link in the description down below. I think it's the second link, should be. Come join the Patreon. If you've like on the recording here, it says hour 40, but obviously it's going to get cut down. If you're somebody that has watched this entire thing through, I would love to chat with you, because clearly you're like interested in the stuff I have to say and that type of stuff. And we've built a community of about 250 members. So far, it's been great. I've had great feedback. A lot of the ideas for the videos come from here. When I'm talking about like title ideas or thumbnails, just feedback in terms of my portfolio decisions, I'm constantly on here almost every single day. I think very rarely am I going to not be active on the Discord. I'm probably busy with something that's like genuinely important, but I'm on here every single day and we have a great time. For example, Toji here has just said, Arya, you should get into YouTube Shorts. I might take up him on that suggestion, right? So anyways, fun times. You should go check it out. And thank you for watching this entire thing through. I hope you found value. You should also check out FinChat while you're in the description down below. You get a 2-week free trial, no card required. Yeah, that's about it. Thank you for watching. Have a great day.